Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Virendra Kumar. Your mutual funds need just these resolutions. For long-term investment success, these three basic principles matter more than market predictions. Earlier this week, I came across an insightful column by Devina Mehra about New Year resolutions for equity investors. It got me thinking about the mutual fund investors among us who often face similar challenges but need a somewhat different approach. While there are dozens of things a mutual fund investor should do, I'm going to focus on just 2 or 3 critical resolutions that can make a real difference to your portfolio in the coming year. The first, and perhaps most important resolution, is simply to be aware of what you own. It sounds almost too basic, but you'd be surprised how many investors I meet who have accumulated a collection of mutual fund investments over the years without really knowing what's in their portfolio. Take stock of your existing investments, not with any immediate intention to make changes, but just to understand what you have. Which funds are they? What categories do they belong to? How have they performed relative to their benchmarks? How much of your portfolio is in equity versus debt funds? This awareness itself is a powerful tool that will serve as the foundation for all your future investment decisions. The second resolution flows naturally from the first. Establish a proper monitoring and rebalancing discipline. Notice that I specifically use the word discipline here. You don't need to watch your investments like a hawk watching its prey, but you do need a systematic approach. Set aside time quarterly to review your fund performance, but and this is crucial, make changes only annually unless there's a truly compelling reason. Too many investors hurt their returns by frequent churning of their portfolios in response to every market movement or news headline. The third resolution, and one I cannot emphasize enough, is about SIP discipline. Systematic investment plans are like exercise. The best kind is the one you actually stick to. Make 2 commitments here. First, align your SIP increases with your annual salary hikes. This is not just about investing more, it's about maintaining the same proportion of your income going into investments as your earnings grow. Second, and this is perhaps harder, commit to not stopping your SIPs during market downturns. In fact, these are precisely the times when your SIPs are working their hardest for you, buying units at lower prices. These resolutions might seem underwhelming compared to more sophisticated investment strategies you might read about. They might not have the excitement of discovering the next multi-bagger or timing the market perfectly. But as I've observed over decades of market cycles, it's these simple, boring practices that ultimately build substantial wealth. Think of it this way. Just as a vehicle needs both an accelerator and brakes to move safely, your mutual fund portfolio needs both growth drivers and safety mechanisms. Regular monitoring provides the awareness to know when to apply which. SIP discipline ensures steady progress, while the annual review schedule acts as a brake on impulsive decisions. The beauty of these resolutions is that they don't require any special market knowledge or insight into future trends. They work regardless of whether the market is bullish or bearish, whether interest rates are rising or falling, or whether the global economy is expanding or contracting. They are based on timeless principles that have served investors well through countless market cycles. As we begin another year, remember that in investing, as in many things in life, simplicity often trumps complexity. There's a tendency among investors to overcomplicate things, to constantly seek the next best strategy or the highest performing fund. But my experience has shown that the investors who succeed over the long term are often those who stick to these basic principles with unwavering consistency. It's worth noting that these resolutions become even more important during times of market volatility. When markets are swinging wildly, having a clear understanding of your portfolio, maintaining your review discipline, and continuing your SIPs can provide the stability and confidence needed to stay the course. Think of it as having a reliable compass during stormy weather. It might not make the journey completely smooth, but it will help ensure you're moving in the right direction. Focus on these basic resolutions and you'll likely find yourself in a better position this time next year, regardless of what the markets do. If staying on course with your investment resolutions feels overwhelming, Value Research Fund Advisor is here to help. With expert guidance, curated fund recommendations, and actionable insights, it simplifies the chaos of the markets and empowers you to make confident, long-term decisions. Let us be your compass in the ever-changing investment landscape.